Hello, this is Jim Riggio. Today is May 8th, and this is the Monday Market Muse. A quick disclaimer before we get started. Capital Discussion is not a broker-dealer or investment advisor. The presentation about is for educational purposes only. We have no way of knowing your situation or what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of trading options can be substantial. Please be aware of all risk prior to placing any trades. Hypothetical computer simulated trades that we discussed during this presentation are believed to be accurate. However, due to such factors as liquidity, slippage, and commissions, your profit or loss may vary. Okay. We got through the French elections pretty much the way we thought that they would. And um, I think that hopefully at this point, what we're starting to see from some of the market movement, especially some of the, I would call it, it's not unique, but it happens very, very seldom. The type of movement that we've had in the market. When I say that, I'm including not just the S&P price, but the price of the price of the options close to the money, the price of the options above the money, price of the options below the money as you go further and further down. That whole skew, okay, as we call it, of the implied volatility had been acting a little bit differently, as had the term structure, meaning as we go further and further out in time in options. And we'll take a look at some of that today. So what I was planning on doing today is taking a quick look at all of that and what's changed, focused on the S&P 500. I think that that's probably one of the best benchmarks. And then I'll end up finishing up by telling you I had a bunch of conversations with institutional derivatives guys that I used to end up working with. I've were colleagues of mine in a previous life, and we talked a lot about how the options markets have been behaving recently and how they've really kind of changed a lot over not only the last, I'd say, 4 or 5 years, but we've gone through, I think, a little bit more of that change appears to end up being here to stay. One of the things that I end up doing in my Kevlar reviews is that I go through my specific trades, but I don't do the technical analysis during my weekly Kevlar reviews for my subscribers. I do that for the Volvantage users, and what I do is that I also end up making that available for my Kevlar subscribers. So I thought what I would end up doing today is kind of giving you a brief version, some of the things that I normally end up going over that I don't show during this Monday Market Muse. The first one is where I always like to end up starting, just always making sure that we all understand from a long-term perspective where we are. What you're looking at here is a long-term graph monthly over a 20-year period in the SPY. Okay, like using the SPY because this is something that, had you bought the SPY, you couldn't have bought the SPX, right? But if you bought the SPY, it includes the dividends. It ends up bringing them in not on a time value daily basis the way the SPX does. It brings them in as they get paid once a month, and so it's a little bit different, but not very. What you can end up seeing here in the very beginning is you see the run up in the SPY, not so much the Nasdaq, but in the SPY from the middle of 1997. You can see the run up that we ended up having. You can see after the dot-com bust how we ended up going down, basically right down into the 2002. When we started 2003, we started this long climb up. We got basically back up to the peaks in 2007, and in 2007 and 2008, we just went straight down. The last few months in 2008, oops, sorry about that. The last few months in 2008 and 2009, you can see we hit our bottom. And basically from there, I don't really think that people really realize that we've been on this unbelievable bull run, okay, for a decade. If you take a look from March of 2009, okay, to where we are in 2007, this is an 8-year run that is bigger than anything that I had ever seen. This is bigger than the dot-com stuff for the SPY, not the Nasdaq. Obviously, the Nasdaq ran a lot more. You can also end up seeing that we had this sideways movement. Let's highlight this so you can end up seeing here. We had this sideways movement where we move sideways with going. It's a little bit different when you take a look at the sideways market over a year and a half period before we basically found the bottom, okay, established that bottom, and then moved up from there. And this was basically at the very end of the year, beginning of January of last year, meaning 2016. We hit lows in January and in February. We ended up touching the bottom again, which was very clearly defined on a monthly chart, right? When you take a look at this, once we ended up hitting that, we had this really clean channel upward. We broke above that channel only to come back into it. Okay, this is going to, and I'm going to show you, this was the breakaway top that we had where we got up to 2,400 or 240 on the S&P SPY. You can also end up seeing how we ended up moving then back towards the top of the channel. Let's take a look at this at a little bit closer level, especially this whole year. The one thing that I wanted to just point out on the sideways movement, the reason why I have this bar down here, you can end up drawing, when you have sideways channels, I just drew this channel down here at 25% because when we went through the monthly pieces, you saw that there was a lot of support or resistance, especially support before we broke through it. And then when we came through it on the way back up, we kind of really ripped back up through it on the way up. Let me close this. And we're going to take a look at this last year and a half. Now, I know that this may look a little bit confusing to some folks, so let me just draw this out for you real quick. A couple of things. Number one, I've moved over to the SPX, not the SPY anymore. Long-term upward trending lines are in blue. Shorter term, by shorter term, I mean anything like 2 years and less. Shorter term upward trending lines are in this purplish magenta color. Downward trending lines are in red. We don't have any long-term trending lines because we've been in such a bull market. But these are the, over the last several months, these are the downward trending lines. Price levels that I found to be very, very important. Bottoms when we've had sell-offs or drawdowns. Also tops like 2277 that appeared to end up being a resistance for a long period of time before we finally broke out of it. And let's take a look at that. So we highlighted, it's a little bit easier to see. This 2275, 2280 area in here acted as resistance for a whole bunch of weeks. You can see how it acted as resistance. When we broke through it, we finally ended up gapping. Now we had this really big gap, only to gap back down. And so we had a gap over here. Okay, you can see this going from January 24th to January 25th. And then we had another gap, okay, from the 27th over to the 30th. So over a Friday, we had another gap down on Monday. Now, when you have double gaps like this, they almost always fill. This here is known as an island, okay, for some of you, market technicians. We ended up having the sell-off, and then we came back up. Okay, you can end up seeing how we ended up moving back up through this, and we filled both of these gaps. We ran back up, and once we ended up breaking 2,300 again, then we were off to the races. You can see that we ran 50 points. Literally, day after day after day, moved higher and higher and higher, and it looked like that 2,350 was going to end up being resistance level, but yet we gapped it again. We had a small gap here that got filled. Okay, and then we had another gap after another week moving higher again. All of these gaps all got filled. Okay, they all got filled. We had this sell-off a little bit, filling, this gap. We ended up establishing a new downward trend line. We had a new high. If I ended up going using the bodies of the candles, and I drew my downward line, we had, a clearly downward defining channel. But we had all of these longer-term upward channels. Let's take a look at a couple of them. The first and foremost was probably this lowest one here. What happened with this lowest one is that I basically drew this upward channel as a support line going from the bottoms that we ended up hitting. I could even draw this a little bit further, but the line would change a little bit. I'll go back in a second to show you these longer term ones, meaning more than just a few months. But you can see bottom, bottom, bottom. We hit all of these bottoms, this great support. So it was no super surprise to anyone that after we had the sell-off and we had the sell-off during the day, that we actually bounced back up above that longer term trend line, and it acted as real support. Also, this downward trend line, when we tried to end up cracking it here, we could not end up closing below it. Okay, we were rebounded during the day. and then we ended up moving up. You can also see that when we came back to it again, it looked like it was going to end up being support. Right? This looked to be like a very, very bullish day on the 11th. And the reason why it looked so bullish to me was you started above the line during the day, the support line that I've been talking about. You sold off hard during the day only to end up finishing above it. So at this point, it looked like it was holding and we were going to move higher, but it didn't. And then you can see for the next week or so that even though we sold off and we started to rebound, it was still acting as resistance until the French primary elections to determine who was. This was the weekend. So we have this huge gap up. Um, we open up much higher. We move higher during the day, but oops, sorry, and sell off during the afternoon and then close. And so many times when you have gaps like this, right? You end up the next day, we'll move sideways, or take maybe a day or two, everything gets congested, and then you end up having a drawdown again. You can see that it's happened many times. It's what usually happens. It's the high probability play that when you have a gap, that you're going to get filled within a week or so. When we were here, I had a vol Vantage trade open. The volatility, both in terms of the skew, the volatility on the options for the VIX, okay, often referred to as the VVIX or the VVIX, and also the term structure of the VIX futures. Excuse me. All showed that there was a great amount of fear in the market, but it was all event risk fear. Now, what ended up happening during this time was that if the candidates that were to the far right, especially Marie Le Pen, had ended up getting into the finals or showed a very strong showing, it could have meant the end of French participation in the EU. They could have gone the same way that the English had done. This would have been more impactful to the entire European zone because they were part of the euro. That would have disrupted the currency. It could have meant the end to the currency. That would have changed every single country, where the English or the British, when they ended up leaving, they were not part of the euro. So it wasn't as big an impact for the euro. What it was a very big impact for was how were businesses going to change. Many English-speaking countries, the United States being the most important of them, in terms of the impact of American businesses and other English-speaking businesses headquartered in Europe chose London for their headquarters. Now, if London was no longer part of the Eurozone or the European Economic Zone, what would that end up meaning? It could end up having a great impact where a company's going to have to leave. What would end up happening in the UK if the UK, and so there was a lot of fear that happened during that time. This had meaning the French elections had a lower probability of being successful, but had a much bigger impact if the right-wing candidates would have won. Okay, and again, I'm talking specifically about Marie Le Pen. She finished second, okay, to Macron, who ended up actually winning over the weekend. You can end up seeing that on the second day, and I had never seen this happen before. We gapped up again. I have never seen 2 days gapping up. You'll see that sometimes, but it usually gets filled. And if it ever has happened, it's usually after the markets have sold off dramatically. Let me show you a quick example. This is the sell-off that we ended up having, and we reached bottom when we talked about in the monthly chart, when we had a bottom in January and a bottom in February in 2016. You can see that when we came off of the bottom the second time, we did leave a gap that we didn't fill. You can also see that this is Brexit. Okay, in Brexit, we ended up selling off really hard, both on the Friday after the election, when the UK voted to end up leaving, and on the following Monday. By Tuesday, we started to recover. By Wednesday, we were off to the races, and we left a gap. If there are gaps that are more have a higher probability of leaving themselves here and not filling, it's going to be these types of gaps where you have this really hard sell off for an event. They realize that the event isn't the end of the world, and then you end up, sorry about that, then you end up getting back to the place you were before the event even started. So this is the type of gap where I'm like, okay, that one I'm not going to bet is going to get filled because this one can end up saying, but all of these that we've seen this year, oh, let me not do it that way. All of the ones that we've seen this year had all filled. And this wasn't any huge sell off that we saw that we were bouncing off of. We did have a time consolidation going sideways. And then we ended up having this run up because the markets were traded in a much tighter range. And so the velocity that we had to sell off on Brexit, we thought that there was a higher probability that these get filled. They still can, right? They still can. But they haven't, and it's 2 weeks later. Okay. I told you I'd take a look at those longer term trend lines, so let's take a look at them right now. Excuse me one second. I just need to get a drink real quick. Okay. Sorry about that. The longer term trend line that has acted as resistance when we've run up over these past 2 weeks has actually been the support line that we drew from the February lows back in 2016. You can see it's basically the lows from February in 2016, the sell-off that we had in Brexit. You can also end up seeing here that when we ended up coming down, we broke it, and then it acted as support. Let's highlight this area so we can see it right here. It acted as resistance, got above it, and so we played on both sides of this line. You can also see here the heavy traffic that we had on the line until we finally ended up getting a break away from this. Now, when we've gotten a break away from it before, like we did in late December last year, you can see we went through a time consolidation, right? We just moved basically sideways to the left so that the longer-term support line could catch up. Once this longer-term support line caught up and we got to this point here, something was going to happen, right? You're either going to break out above it or you're going to break down below it. A pattern like this where you keep bumping your head against it and your support line's coming up and all your moving averages are coming up to usually breaks to the upside. We gapped. You can then end up seeing what I've done is that I've drawn horizontal lines on where you could see that there was clear resistance, right? The 2300 line, not only is it a nice round century mark, but you can end up seeing that for 3 days here, even though we gapped up, we weren't going up any higher. We ended up coming back down. We went back up. We hit our head against it a few times until we finally broke through. We broke through it in a big way, and then we moved higher. The other line that ends up being rather important, and I have to go back again here, is that if I end up showing over the last 2 years, I showed you what the support line looked like coming from the lows of 2016. Let's take a look at the top line that was the resistance starting in early 2016. You can see here in the second quarter in late April, we ended up hitting a high. I drew the line along the other highs. We ended up having it definitely be, after this huge run up, we had it definitely be resistance here. When we got up to it, we paused, if you want to even call it that, for a day on it, but then we end up moving even higher. Okay. Now, this support line you can see here, it had turned itself from a resistance line to when it came back down into a support line. And right now, during the last couple of weeks, and let's highlight this area so we can really zoom in. You can see that this is that longer term line. Okay, we've come down and it's acted as support, and so we have another scenario where do we move sideways? Right? You have one of two scenarios, I think, that happen at this point. We move sideways until these longer-term support lines end up catching up. We end up having this flag pattern. We get squeezed into tighter ranges, and then when we break up, we probably break up to the upside. If we end up starting to sell off and we break these support lines over the next several days, then these gaps, come into play. So I think that what we'll see is that we'll be in this tighter range. I'm going to call it from just over 2,400 to, let's call it even down here at the bottom, somewhere in the 2,385 range. And we stay in this 15-point range until we break out of it. Now, remember, the downside of the range catches up every day, meaning the further we move out to the right, and let me draw this here. Let me do it this way. What is it? Price access. No, it's time access, right? Yeah. And let's go out 15 days so we can see what happens. All I did was I put 15 days out here to the right side. So what ends up happening, especially okay with this line here that looks like it's going to end up crossing just once we get up, the range will get tighter and tighter and tighter. And if it does and it stays in this range, when we break out above 2,400 in a meaningful way, then we end up running up. If we break through this support line, then the gaps come into play. Okay. This type of technical analysis, looking at the charts, to me is the most useful method of technical analysis that you can end up doing. Okay. I'd like to end up pausing and asking, any questions if there's anything you'd like me to go over, if there are specific areas. But this is the part that I think becomes the most critical. Okay, I'm going to go on because I have one more chart. So just type in your questions as you go. I can always come back to these charts. Okay. What I have here is that I have that long-term channel that we started at the end of 2015, beginning of 2016. Okay, and you can see a nice, clearly defined channel until we broke above it here. So let's highlight this area. Okay, even better, maybe to here. Okay, so what you can see is that once we broke above, I missed the top of that channel. This is where I wanted to end up going. Once we broke above the channel, okay, it seemed that it was going to, at least for the next couple of days, we held the channel. If you're going to hold the channel, okay, meaning you're not going to break through it, now that top of the channel that had been acting as resistance is now acting as support. We now end up moving higher, and then we have this big gap. And we've talked about the gap's filled. But when we started to end up selling off, you can see that the top of the channel held. Okay. The other thing that you can end up seeing here is this blue line is the 20-day simple moving average. It held. We tried to get below it. It held. When we broke through the 20-day simple average, moving average, and that upper support line, you can see that we broke straight through the channel, and then we ended up moving sideways for a while, for a fair bit. You can see that this green line is that same aqua color. I didn't want to use aqua again, but it's that same aqua color support line that we ended up finding. The one that I told you was most important. So we moved sideways, but what was very important in this month or so that we've moved sideways is that we made a series of lower highs. And this was a really important one because not only did we make a series of lower highs, but we went up to the channel and we couldn't end up breaking it. Okay. And so at that point, it looked like we definitely had formed this lower channel. We started to end up having a sell-off. Now you'll notice that, right? For those of you remember candle, if they're candle on down candles, red candles, it means that we closed at the lower end of the right body. If they're green candles, it means that we closed at the upper end of the right side of the body. And so on this day, when we tried to break the channel on the way down, you can end up seeing that we actually closed higher and above it. So we couldn't close below it. So this was actually, while it was a higher low, if you look at your closing prices, it was actually a lower close than this day. So everything looked like at this point we were set that we were going to end up going lower, and we just started to move sideways. We got into the French elections. We gapped up. We got above that line that had been support, which during this week turned into resistance. We gapped, and look at this day. Critically important support line turned into resistance. We gapped through. Downward channel, we gapped through. Okay, the 20-day moving average, because we closed below it. Remember on the right side over here. So we gapped through the 20-day and the 50-day. And two critically important support and resistance lines, all in a single bound, right? One huge gap. Usually you don't see so many important points that are going to act as support or resistance all break in a gap. I spoke to a lot of professional, active, and also probably a half a dozen retired, okay, traders, guys that ran large trade desks. We went through this, and every single one of them played for the gap to fill the next day. Okay, and what ended up happening? It gapped again. And so this was really, really surprising to, I think, a lot of historians, a lot of market technicians, a lot of guys that, 20, 30, 50 years ago became multimillionaires because they were really good at reading tapes. Okay. And so, but it didn't happen. And by the way, one of the things that we have to end up realizing is that when you play for a probability and it's wrong, okay, admit you're wrong and you're out. So what ended up happening was the next morning, I knew people who got short on this day. Okay. What happened the next morning? Everybody was out before the end of the day. They were like, you know what, we're wrong. This thing, sometimes, you have a gap up in the morning and you can end up even selling off more. Nope, it's not happening. Get out. And you can see then for the next 2 weeks that we moved sideways. Moving higher into the French elections, it got to be very, very evident that you have to understand Marie Le Pen was the far right candidate. Who she lost to Macron was he was the new kid on the block, if you will. Uh, he was more of a centrist, which in France puts you to the right side of the average population because they're much more lean to the left across their country versus if you compare them, say, to the U.S. Our center, right? Our center, if you consider left and right, in terms of our political environment, our center is to the right of where France's center is. And so they had basically the choice of a far right candidate or a centrist leaning a little bit right candidate. And so it was pretty clear to a lot of the polls. And now they also had not just the polls, but they also ended up having their quote unquote, we would end up calling it kind of like a primary type of runoff. They had all of their candidates, and then just the two top candidates ran. So we went through this sideways motion for a week as we moved higher into Friday, especially at the end of the day. It was like, okay, they're getting ready to make a run at 2,400 again. And so I had thought, okay, the futures opened up relatively flat last night. We opened up this morning again. We were flat, maybe down a point. Okay, when I started to write at about 7 a.m. Eastern time, um, and we haven't run above it. So now we have this really important long-term trend and the 2,400 line that was our previous highs, both acting as important resistance. And usually, okay, when you have multiple resistance lines like this, you can end up breaking through them, and having good news helps. Okay. Thought that with the French elections behind us, maybe that was going to be the catalyst to be enough good news to end up breaking through it. But I guess the bulls were just a little bit tired today after breaking through all of these other support, resistance, and really important moving average and trend lines. They don't seem to have the energy to end up getting through the 2,400. Does that mean that they can end up staying down here and just going sideways, let the support lines catch up to them, and then make a run for it, let's call it in another week to two? Yeah, that's probably what's going to happen. From a statistical or a probability model point of view, that's probably what's going to end up happening. Why end up trying to sprint through this thing? Because sprinters can get tired like this and then sell back off. And sometimes if you've, wasted all of your energy in this one huge run up, there's nothing left to end up buying, okay, as things start to end up coming down. And that's what this blow off top, okay, look like. For those of you who haven't seen it, I'd go back. There was a whole bunch of research that was done by another firm that I ended up quoting on here. They had shown blow off tops going back to the end of last century, meaning the beginning of 1900, using the Dow. And blow off tops almost always get filled, and that one did. We haven't had a blow off top here. We're actually going through a time consolidation. So if we go through a time consolidation for the next week and then the market starts to move up, I'd say that's a much healthier market. Okay, I can live with these gaps if we move sideways for the next couple of weeks. That now I don't think they're going to get filled. Right now, there's still a decent probability. What would be better in terms of health of the market if you're looking for a nice, strong, bullish market? Sell off, fill these things, build a new base here, come back, get to 2400, maybe pause at 2400, build another base, and then run through it. At that point, if that happens, then they can run up to 2450, 2500. I think without any problem. Leaving these things filled here, leaving these things unfilled, these gaps unfilled, means that there's still the possibility people worrying, do we end up pulling back? I mean, it's a technical indicator that a lot of people don't like to end up seeing left behind. Okay. A couple of questions. The March decline that broke the bull trend line, okay, from November is demonstrating a sign of strength, okay, from the bears. Yes, that's definitely true. When we ended up having the sell-off, and this particular day. So this particular day here was a huge down day because we opened up higher, moved higher in the morning, and then just sold off incredibly. It was on this day, March 21st, that I would end up saying, I that was the first time when I thought, you know what, the Bears are finally ended up getting their say. At that point, we had our first lower high and our first lower low established. Okay. The market is now testing the prior high due to lack of buying by the bulls. Okay. Will give the bears a chance to gain control again. Yes. Yes, it will. Okay. So what ends up happening is that if we can't break above 2400, okay, and we go sideways, this is going to get to be a tighter and tighter range. Now, which way do we break? Let's get a little bit more to the right so we can end up seeing this. Again, let's go over to time. Let me get 20 days over here. Let me move this just a bit smaller now. Okay, and this is really what we wanted to be able to see right from here over. Okay, so what ends up happening is you can see how the lines end up getting tighter in here. Now, if we stay within this range and even a little bit above 24, you can see the longer term channels moving up. But if we end up staying in this range and we break below this longer term support line, the screen line that we have, this trend line, and we go and we end up establishing, breaking through these, I would end up thinking because of the high congestion that this area in here, let's call it from 2325 to 2350, right? These 25 points in here would be a very, very strong defense point for the bulls to set back and do all of their buying back here. Let it run through the two gaps. Don't try to defend the gaps. Because I think what ends up happening is that if you break into that first gap in here, it's a small enough gap. They tried to test it twice. They didn't fill it. They got partially through it, but they haven't completed it. This is the big gap, right? So it's really once they end up looking at that 2370 area, that if we end up coming down to here, I think that we definitely get filled and go down to 2355. So I think there's almost a vacuum. Okay, that's what gaps are, right? Vacuums for a good 15-point drop in here. Now, the question is that if the bears get that far, right, and that's talking a lot. If the bears get that far, this will be a zone, okay, in these 25 points where the bulls will set up, okay, to have their biggest defense. Because you can end up seeing, if I go back here, we ran up, and this was the area where we moved sideways also during this time after the big run-up. And so do I think that we're in jeopardy of going all the way down to the bottom channel? Probably not. But do I think that we're going to have a significant run in one way or another? Not today, not tomorrow, but within the next 2 weeks? Yeah, I do. I think we're going to end up having a movement. And what's significant? We can move, 50, 75, 100. Okay, we could even move 100 SPX points. I don't see us being able to move much more than 100 SPX points without, where we currently are, without doing a complete reassessment of how we got there or how we got to the upside, for that matter. Those are more difficult. There's nothing also that's driving it from an economic or a news point of view. Um, we've run up here a lot on optimism. The economy has gotten slightly better, but it's been a lot on optimism in and around lower tax rates and greater government infrastructure spending. The economy and the earnings of companies have started to turn around. We're still at a point where, you don't know for certain, okay, will everything that the markets run up on that they've been optimistic about, will that all come true? Will that all come to fruition? That will saying, yes, look at how things are, and then there could be another bump higher. I think that the market's set up where if the good news comes to be true, we move up a little bit. If the good news that we've run up on in terms of the optimism of the good news, if it disappoints, I think that we have more downside potential than upside potential at this point. Okay, and that's an important thing. So how do you end up trading this? Um, Had a couple of really big challenges. Let me come through and show you. Let me get rid of. I don't want to show you these. Okay, I'll show you this real quick. These trending lines, you see these solid red and solid green lines and the dotted lines. These are linear regression channels. You can see them up here that I've done a linear regression channel for 100. I've also done a linear regression channel for 50. The reds on the top and the solid red on the top and the solid green on the bottom are the 100 linear regression channels. The 50 linear regression channels are the dotted lines, upper line 50. It's very difficult to end up getting above the 50 for any period of time. You can challenge it, but it's difficult. The hundreds, on the other hand, the 50s will work as support a lot of times, but don't be surprised if the 50s break and you come down to 100. They change directions, obviously, with time, so long you end up going back. You can also end up seeing the Bollinger Band, which is this curved red line on the top, curved green line on the bottom, and the blue line is the center line for the Bollinger Band, which also happens to be the 20-day simple moving average. So you can see that we have a lot of support lines, especially, let me come over to here, just highlight this here. We have a lot of support underneath us. Okay, so here again, we get to that 2380 area that we talked about before, that we're in this range between 2400 and 2380, and the 2380 closes a little bit every day. Okay, so I just wanted to see more confirmation on some of the momentum factors. Wanted to end up showing you this one real quick. One of the things that we had move from the U.S. elections is that the small caps just moved up huge. If I go back, let's go back maybe 9 months. You can see what happened here after the U.S. elections, right? We ran up just absolutely huge compared to everything else. The NASDAQ, on the other hand, moved sideways and actually underperformed the S&P 500. Okay, especially because it didn't sell off as much, and so the S&P 500. If I was to start it from this point, you can see that the S&P 500 moved up much faster than the Nasdaq. So when you were looking at this from what happened right around the U.S. elections, Nasdaq terribly underperformed, and even sold off a little bit into the end of the year more than the other markets. The other markets being the S&P 500 in the candles and in the solid line. I used the SPX here, and then you can see that the Russell moved up just hugely off of the elections. Well, the Russell had basically moved sideways. And what I got concerned about is that when I started to take a look at what was happening over, let's say, the last month or so, maybe 3 months would be a better view. Okay, so what happened was that the Russell had started to sell off here, and the NASDAQ was moving higher. Okay, and so during this time, we have the NASDAQ now catching up, and the reason why the NASDAQ is moving up so much over the last several weeks is that it's really been consolidated in the largest mega cap stocks. Now, I learned this. This is a very this is probably the most expensive lesson I've ever learned in my life. And when you lose money, if you walk away with really important lessons, at least you can feel that I've learned something. Paid a lot for that knowledge, but I've learned something. I, like most people, okay, who were trading, got crushed yeah, when the dot coms ended up imploding in 2000, 2001. We ran up and we actually made our highs in March. What ended up happening towards the end of 1999 and I'd say February into March, okay, of 2000, when we ended up actually getting back to our highs right at the end of December. Because for those of you who don't remember, 2000, we thought, oh my God, the computer systems are going to all crash. Okay, year 2000 problems. It's going to end, and it didn't quite end up happening. So there was kind of this fear in the beginning. You heard about every little issue was being reported in the industry. When it turned out not to be so bad, we had this relief rally. We run up in February into March. When we were running up, market participation narrowed. Okay, that's a very important one. Market participation narrowed. Okay, it cost me more than $1 million to be able to say that. Market participation narrowed. I don't cry or scream or anything anymore. Okay, and I didn't have to end up going through a bunch of psychiatric treatment to be able to say that. But it was a very expensive lesson. What do I mean by market participation narrowed? When you take a look at the individual companies that make up the index, all indexes, with the notable exception of the Dow Jones, are market cap weighted. So in the NASDAQ, if you have Google, Apple, Amazon, um, all running up, Facebook, right, all running up big compared to the rest of the market. Those four stocks can carry the NASDAQ, and you could have those four stocks up, the other 96 stocks down, and if they were up strong enough, you could actually have the NASDAQ be higher on the day. This run up was rather narrow. Okay. And so when this run up continued, especially from this point here, this was a critical point, I thought, the end of April. What ended up happening at the end of April, the NASDAQ continued to run up. The smaller caps, which aren't nearly as liquid, the big money isn't going to go and put a ton of stuff into, a whole bunch of small caps versus, hey, let's go into the mega caps that everybody knows. Indexing has made this problem worse, but proportionally worse. That's why I like to take a look at all three of these indexes, the NASDAQ, the S&P, and the Russell. So during this time, when we started to have this sell-off, it just scared the living bejesus out of me because market participation was narrowing. Okay. And I got hurt really bad. I mean, you can tell how. I mean, it was 17 years ago, and I still, though those scars are still haven't healed. And when that ends up happening, this could be a sign that things can start to end up turning. Right. This is one of the signs that when you go back and you take a look at what were the signs that showed you that we were reaching a top after the dot-com boom, it was that market participation narrowed. And so with the narrowing breath, right, a lot of people would call it breath also, with the narrowing breath and the smaller caps selling off compared to the NASDAQ larger caps, mega caps, it concerned me. It concerned me. Okay, so these are the types of things that when I'm looking at the market, believe me, that's not my only scar. I have so many scars of losing money. I joke, especially when I'm presenting with Dan Harvey. Dan and I joke sometimes, saying, we've lost money in new and innovative ways that you guys haven't even thought about yet. Okay, don't worry, give it time. You'll learn how to lose money the way we did also. And so, where do we end up going from here? This is one of the signs that unless the Russell ends up starts to catch up, unless we have a wider breadth of participation of the S&P and the Nasdaq stocks, meaning that more of them go up compared to going down, then I'm going to end up remaining worried. Okay. These are just different times. This is industry groups. Don't have time to go through industry groups. I have time to end up going through this. What you're looking at here, okay, what you're looking at here is the VIX futures. Okay, the VIX futures by month. They're color coded, kind of like the colors of the spectrum, where I kept the shortest color in this bright blue or closest to violet that I could end up finding. Then a lighter blue, green, and it's the front month. Okay, is the lowest. Okay, the front month currently, and you can see this right here, by the way, in K, right? K7. What K7 means is K stands for May, and 7 is 2017. So if you take a look at the letters here, I'll go through them real quick. You can take a look at them if you search on the CFE website. You can end up finding them. You can also find them on the VIX, okay, CME or CFE websites. You can find them. But just to go through them real quick, okay. K is May, June is M, July is N, August is Q, September is U as an umbrella, October is V, November is X as an X-ray, and Z stands for December. And so what we're looking at here is the first month, as I ended up already mentioning, right? K is May, so we're looking at May, June, July, August, September, October. And when you have this nice, clear delineation between the lines where you have the largest gap, okay, between the lines being in the first 2 months and then the second largest in the next 2 months, this is a healthy market that looks like it's moving sideways to upward in the near term. And so this is known as contango when this ends up happening. For those of you who just want to end up taking a look, if you take a look at VIXCentral.com, okay, they have the current prices 15 minutes delayed, but it doesn't end up showing you the kind of noise that we had here 2 weeks ago. You can go back and you can take a look at it. But this I really liked being able to see because back here, this was before the Aprils expired. And so Aprils were even higher in here, and it was just a complete mess in the first, 3 months, meaning that the front month was higher than the second month got higher than the third month for periods of time, and that's known as backwardation. This is what happens when there's fear. Now, the fear was going into the French election, so it was event risk fear. Event risk fear. After the event passes and the worst doesn't happen, things calm down again and we go back into contango. Okay, so because implied volatility is so low, because contango is so well defined here, to me, this is probably the single biggest forecaster of what the market is going to end up doing. And what the contango or what the VIX futures tell you at this point is that there is really no fear in the market at this point. Okay, so unless we break through those lines, those support lines on the downside, and then at that point, things are going to start to end up heating up a little bit here. But as long as those support lines hold, okay, we're going to end up staying in contango, and the S&P is going to move sideways to up. Okay, very, very important. Don't need to see that. Okay. One last thing I wanted to end up showing you, and it's going to take a few minutes to load, I think. Actually, is Thinkorswim. Okay, and so I need to come over here. Let me do this. Okay, it's going to take a couple minutes to load because I hadn't preloaded this. I wanted to end up taking a look at the skew. When we look at the VIX futures, and that's known as term structure, right? We're looking out in time. I'd like to take a look at what that looks like, not just in the VIX futures as a single number. I wanted to take a look at what that meant in, let me hit pause here. I want to take a look at what that ended up meaning going forward. Okay, going forward, and let me see if I can just hit. Okay, let me get rid of this. Let me make sure I have. Oh no, I do want to keep that in here. And I have all of my dates. Okay, what you're looking at here, just a graphical form. It's a little bit better than Thinkorswim. Considering that it's a free tool for LVX, okay, subscribers, or if you use LVX as a platform, that's the old LiveVol platform that has been purchased. It's not its own company anymore, but it's probably one of the better tools. Now, here's the whole thing: the rest of the platform isn't that good. Okay. There are issues with a whole bunch of areas. This is the single part of the platform. The reason why I end up keeping a small account there was to end up getting this tool for free. Right? It's a very, very strong tool that I end up using. And so what I'm looking at is the monthlies. I'm looking at the April, the May, the June. You can see the colors here, like June is yellow. I'm looking at July, which is a brighter color yellow, and then the September. What you're looking on the left-hand side of the graph is the implied volatility level, okay? And what you're looking at the bottom price of the graph is the price of the SPX. So basically, it's strike prices. I'm looking 10% up and 10% down. You see that number here, and I'm only plotting options that are more than a quarter. Okay, so you can see all of those there. Okay, and I've gone back a month, okay, to April 10th, and it's showing me one full month of data. Now I can hit play, and it'll end up playing almost like a movie where I can end up watching day by day how the skew changes. Okay, and one of the things that you'll end up seeing here is that how we've gotten steeper, right? I'm sorry, I don't know how to get rid of these lines here because the way I've done it. So I go back one day. Okay, what you're seeing here is now the line's getting steeper, especially the May. Now, what's happened is that we've already been relatively steep 60 days out, but what's happening is that as we get closer, we're getting much, much steeper. Now, the other thing that you'll notice is that as time goes by, Paul Demers is the one who first called it this. This area right in here, it's the belly of the curve is what we call it, because we're in pretty much a straight line, okay, in the puts going down basically almost to the money. But when you get above the money, what ends up happening is that you get this little bit of curve, because what ends up happening is that at this point, implied volatility is going to end up starting to move up because the price is so low. So, for example, let's choose the 24.50 call. It's bid at 45 cents, asked 60 cents. Its current volatility is 7.18. Now, the reason why that volatility is a little bit higher than the 6.99 if I go down 15 points is because it's so low priced that adding an extra nickel, okay, to this particular strike, because it's only 45 cents, and it's an SPX strike, right, will end up changing the volatility to move higher. Now, where does it move higher? Well, the more time that you have, the further to the right the belly of the curve goes. So one of the things that Paul and I look at is where the bellies of the curves are going out in different months. Now, here's one of the things that affects your trading rather significantly. Most people are putting on these butterflies, okay, usually using all puts, okay, below the money, centered. Where do you put your long put? Some people put it right below the money. Some people put it at the money. Some people put it a little bit above the money. The problem is that, let's say, if you started to end up putting it at the money, the value, okay, will lose the most amount of money because it was the highest price put. The value will lose the most amount of money for this put slightly above the money, right? Because it's the one that you paid the most money for if you look at your individual legs. And so this ends up losing a great deal of money. Now, it always will lose the most amount of money. And the key is that I am selling short, okay, puts somewhere below the money over here. And so when I'm selling puts over here, if it runs up too much, okay, I'm also a problem because I don't want my long options to lose IV and my short options to gain IV. And that's what happens over time. And so what you've found is that if you are have any type of trade. Now realize with the butterfly, if you have any type of trade where you're buying at the money and selling below the money, what's happening is that, ooh, it looks really good because I'm buying remember, when you're buying an option, you're buying the IV. When you sell an option, you're selling the IV. IV and price are, I'm going to use the word interchangeable in terms of their direction. If IV goes down, all else being the same, if IV goes down, price of the option will go down. All else being the same, if IV goes up, the price of the option will go up. So what's happening is some people say, oh, look at this. It's really, really steep. I'm buying over here at a low IV, 60 days out, and I'm selling here, and there's this big difference that I have in IV. Yes, I see that. That's great. I'm really happy for you. What's going to happen over the next month, or what has happened over the next month? Well, what you bought has lost IV points, so you've lost money in your extrinsic value. And what's happened over here? It's gained IV, so you have gained, in the price. So if you bought a vertical, you bought an IV that lost money over here, and over here you sold an IV that has gained money. This has played havoc on standard types of butterflies because it is the right leg, meaning the right side of the butterfly, which you're buying the vertical on this side, that ends up really hurting you more so because the prices are higher. The left side is the exact opposite, right? If you think about this, well, here what I've done is that I'm selling something in here. And so the IV's gone up maybe just a little bit. Maybe I've even sold it over here, so IV has stayed flat, and I bought something very far below the money, and its IV's gone up. But look at what's happened here. Yes, its IV's gone up super high, but it's only worth $1. Okay, when I bought this option, maybe it was worth $6 or $7. What's happened here? In the center strike. Okay, maybe when I ended up buying it out here, it might have been $20, and now it's $3. So it's a relationship. What ends up happening? Two things really have to happen. Okay, for our capital discussions, types of traders that trade these types of trades. You're going to have to look at your timing, how far out you go, when you go into trades, when you get out of trades. Okay. It's difficult. I will tell you, what makes it the most difficult right now is holding these trades, I'd say, from 5 weeks down to 2. Okay, that's a point where we used to make our bread and butter. Okay, it's when all of our trades came in. We're going to make less money during that time if this continues. So people say, "Oh, can I trade the last 2 weeks?" You can. You're going to be very profitable. Okay. However, when you get hit, you still have all of that gamma risk, and the gamma risk is actually even compounded somewhat because the IVs are so low. So if you could trade in and out of gamma really easily, or you're a great gamma trader in the last 2 weeks, go for it. I can tell you, I don't know a lot of people that are great gamma traders, and the great gamma traders have really turned into really short-term traders, and now they become computers, right? It's the high frequency guys, so it becomes more difficult. That ends up meaning that we start to end up pushing out in time. Well, that's already starting to change also. So now we have to start to take a look at strikes. At what points do you end up taking a look at your strikes? Where do you end up putting things? I will tell you the thing is that from my Kevlar perspective, because I was affected by this, and I'm in the middle of it right now, also being affected by it. I am in the process of going to change my structure somewhat. I've changed it a lot for the broken wing butterfly when I have different wings when things go forward. Haven't changed it so much for the type 1 when IVs are low and put skews are steep. That's going to end up changing. What's happened during this time from an institutional basis is that I've had, as I mentioned to you earlier, conversations with a whole bunch of traders. I told you about the older traders, about the technical analysis and everything, but what I didn't mention before was the volatility guys, the ex-Goldman guys that I deal with, some of the guys at EAB and some of the other places. They described the current implied volatility as being something that they have never seen in indexes before. It has gotten, they had thought that we had established this like new normal maybe, 2 to 5 years ago, where things got a little bit steeper in certain things. But what's happened basically more and more since the rebound after the U.S. elections is that there are several factors, okay, that have changed things. They believe that, I guess we started with a Greenspan put, it's gone to the Bernanke put, and now we have the Yellen put. That the Federal Reserve is not going to let the market sell off, and they've shown that they'll do everything. They'll even buy, they'll even, one person said that they'll even eat their own children not to have the market go down, meaning he was referring to that they would buy their own bonds. Okay, that's what quantitative easing was. And when do you remember things like when the Fed several years back, Bernanke started saying, "Well, I think I'm not going to buy as many bonds." Okay, the market sold off horribly because the word he used is that they were going to taper their approach, lessen their approach of how much they were going to end up buying, and the market sold off. Right, I don't know if it got to the public, but what all the institutional guys would call it, they called it a taper tantrum. Okay. Oh, if the Fed's going to, and so you had that number one, but that hasn't changed, right? So that basically changed things coming out of 2000 and let's call it 10 or so, or 2009 when we started looking at some of these things, and so that's been around for a while. Okay. Second thing that's changed after Dodd-Frank, large institutional banks, okay, the big broker dealer guys, were not allowed to end up taking as much risk. They had to end up not trading their own capital, which meant that if they had less capital to end up trading, because their margin requirements were getting greater. It wasn't just for the large banks, but it was for all of the institutions, the hedge funds, all of that faster, some people call it fast money, other people might call it smart money, but it was all of that institutional type, high frequency, algo type stuff had to change. What would they love to do? They'd love to end up selling the super high volatility over here and accepting it, not have to buy something even higher. What happens if you have a margin issue? You can still sell your puts where you wanted to sell them, but now you got to buy some tails. Where are you going to buy the tails? As far out as you possibly can to end up doing your margin control. This was probably the single biggest issue that drove low volatility higher. Well, low volatility mean lower strike price, right? Low strike price volatility higher and kept the at the money volatility suppressed. Add on to this during this time that we take all of the VIX-based ETFs and ETNs, and now you have, billions of dollars being traded every day in products that the public couldn't get to before. And so now you end up having the public, meaning the ETF and ETNs, and also other institutions. So these things move tremendously. One of the reasons why the put skew on the SPX is, I think, permanently higher than what the put skew looks like on the RUTs is not only because the RUT can end up moving a lot more and has a lot more intraday or multi-day type volatility, but you don't have as many institutions, okay, using it as its method of being able to end up trading options. You're going to use the SPX and the SPY. But probably the most important factor of this is that there aren't any RVX-based products that trade in any type of volume. They've tried to introduce them. If they haven't failed, they should have failed by now because there's just no volume in them. And so with no volume, they're not going to end up being there, and hence they're not going to end up having the same influence. The VIX-based products have gotten to the point where the tail might not be wagging the dog, but the tail, meaning the VIX-based products, are pretty much pushing the SPX options around that they have to end up having this type of structure. This line will always end up being straight unless there's event risk. Why will it always end up being straight? Because if there's any kink in it, in any way, shape, or form, one particular strike is a little bit lower, the algos, the high-frequency guys, have all been programmed to pound the living hell out of it until it does become straight, because it's basically free money for them to get this line to be straight. When will you see a bump? When there's event risk, when there's actual real demand to end up buying in one portion of the curve more so than others. Event risk could end up happening. You might see bumps if everybody tomorrow decides, you know what, I can handle up to a 3% loss, but I don't want to take a 4% loss. What will end up happening? You'll start to see a bump around 4 or 5% below the money because that's where everybody's going to be buying their puts. Okay. And so it really is market demand, and market demand being not at any specific strike, you'll tend to see it be very, very straight. Okay, let me go through and see. There are a few more comments in here. The first one says that market participation's narrowed. Okay, when I was talking about in the large NDX, large caps, as I had mentioned, Apple, Facebook, Amazon, Google, things like that, versus the rest of the NASDAQ? And the answer is yes. The answer was both. I could not show you on a graph how the large caps ended up moving significantly. But on one of the things, I don't know if you've ever seen this map. Let me pull this up so that you guys can end up watching this real time if you ever so chose. If you don't have a life like me, and this is what you end up doing during the day. Okay. I just have to get this detached. Boom. Here's what we got. Okay. So what you're looking at is if you tap on the on Thinkorswim, the Market Watch tab, and underneath there's subtabs, this is the Visualize tab. And so one of the things that I will end up going and looking at is I will look at the indexes, and in each of the indexes, the size of the box is proportional to the market capitalization. So if this Apple box, let's say, and I don't know the exact numbers, right? So I'm going to just make numbers up. But let's say if this Amazon box is twice the size of this Apple box, that means that Apple has twice the market cap of one another. If let's say this Amgen box over here, okay, right? You see Amgen, the AM. Let's say if this box is half the size of Amazon, that means that Amgen's market capitalization is half the size of the Amazon. So when I look at this, and I keep this, I flash through them just usually once a day. What happened on some of those really, really big NASDAQ days is that all of the really big boxes were green and the little boxes were all red. Okay. And I'd go and I'd take a look. Now, the Russell 2000 is a little bit different, right? Because the Russell 2000 is mostly small caps. Okay. But when you go and you take a look at, let's say, the S&P 100, very useful to take a look at the S&P 100 because you don't have all of that, I'm going to call it noise, those pesky little 400 companies, those tiny little 400 companies that aren't in the S&P 100, right? I'm looking at the S&P 500, companies 101 to company 500 in terms of market cap size. I can take a look at all of them. And what you'll end up seeing, okay, what I ended up seeing was that the larger caps, especially the technology ones, okay, were green, and there was a lot more red. And so, yes, there are all of these different ways to be able to end up seeing, okay, what participation is. This is, I think, a really cool visual that you end up getting on Thinkorswim for free. Okay, it's like I said, it's on your market tab. Watch visualization. It's definitely worth it. If, by the way, you've seen as I move the cursor around. I don't know. Let's say if you're into utilities. Okay. Well, this little box in here are the utilities. So if you're not sure of what the symbols are, Southern Company is SO, Duke Energy is DUK, and so you can end up seeing each of the individual companies, okay, in the market sectors. Technology's up here is the biggest sector. You can end up seeing how big it is. Financials are down here, and so since it's broken down into sectors, you can see also which sectors are higher. Now, I also have another thing where I look at the ETF or the sector select spiders, and I compare them on a daily basis. But this is a nice way just to kind of get a quick view of the market in a whole glance. Great question, okay? And that's why I want you to ask questions. A lot of times there's a lot of information and great tools that I'll use behind some of the information that I'll give you. I try to end up giving you the most important stuff, but this is the way you guys can end up looking it up and take a look at it yourself. Okay, what's the cause of the big decay at the money from the put side? Okay, what's the cause of this? Okay, this big drop versus this. Um, the answer, and I've spoken to a lot of people at this. Okay, um, this has happened. It started to end up happening. The skew started to end up happening um, after the 1987 market crash. It got worse and more prevalent. Okay, after the dot com in 2008, it ended up happening. But remember, I told you things have really happened in the last, say, 2 to 4, maybe 3 to 5 years, almost at this point. 2.5 years ago, I guess everything happened where this thing really started. Um, it's the high frequency and the algo traders. The institutional guys will end up running this. And what they found is that they found out what the floor traders knew 20 years ago. So you get some options floor trader who never kept up with technology. Okay. And they would know that a certain type of butterfly ended up working. Or you get some guy who's only an options trader, but he built all of his strategies, 10 years ago. Okay. They don't work anymore. You know, did you guys ever wonder this? Okay, think about this. The Weirdor, okay, started, many years ago. Dan Harvey put together and saying, "Hey, I have this put side of my iron condor and the call side of my iron condor. I need to worry and I need to protect more of my put side of my condor. How to end up doing this? Hey, how about if I buy a small little put vertical in this thing?" He did some back testing. He put in a call to Stephen Shannon and I. I had mentioned this to you. I don't know if it was to this group. Stephen and I were trading partners at the time. Worked absolutely great for many years. What ended up happening? As skew changed, where we ended up putting the we called it a Jeep because the reason why we called it a Jeep and not a Weirdor, one was that we weren't going to share our stuff because Stephen was trading a charitable, very large charitable trust with it, along with a couple of very large accounts. I was trading it in a hedge fund. Dan ended up sharing his set of rules. Weirdor became very popular. Paul Demers worked for me when I was running a hedge fund for a while. We ended up doing just a ton of work together. He ended up doing a ton of back testing on things, and hence a set of rules ended up coming out of these things. Why doesn't Dan trade the Weirdor anymore? Why don't Stephen and I trade the Weirdor anymore? It's not as profitable. It's too difficult to manage. It has too much risk. Okay. Why is that happen? Because the thing is that the rules that we built this thing upon were built before we ended up having this rather large change in the way the put skews start out and the way they morph over time. Do they still work? Yes, you can still get a Weirdor to work with the old rules. Okay, Amy Meisner's proved that. Are they as profitable as they used to be? No. Do you have to take more risk to keep profits in them? Yes. Okay. And we haven't had any large pullbacks, okay, that we haven't recovered from in a day and a half, okay, in a few years. What would happen if we got any real volatility? Man, okay. I can tell you, you know the therapy that I told you that I should have gone to after the dot com? Um, the Jeep therapy that I needed to end up going into when we've had some sell-offs in 2008 and afterwards, those were other deep scars that took a long way to end. Why did Dan Harvey, okay, go into this road trip trade and I build a Kevlar? Because it took advantage of the change in the skew. Has it been more difficult over the last few months? We haven't been losing money. Okay, over the last, say, since the election, not in totality. Okay, yeah, have been there been a couple of small losing months? Yeah, 1%. Okay, loser here. It's okay. Right now. I have a trade that's down, like 1.5, almost 2%. But it's still got a month and a half left, or a month left to go. Month, yeah, a little bit more than a month and 2 weeks left to go. Um, has it been more challenging? Yes, but it is better managed risk. Now, the challenge that you end up having is that what ends up happening in this new environment when we have very sharp sell-offs? You have to really study what happened, okay, last February. What ended up happening, okay, during the whole during the whole election that we ended up going through. The election in Britain, okay, for the Brexit vote. The election in the U.S., the election in France. Okay, we're coming up. Okay, we're going to have other elections in Europe also. Those are all rather big challenges. Let me show you one where I can show you this rather simply. Let me just get a. I don't have this one up, so I just need a minute to end up pulling up another chart here. Let me detach. No, let me just do it this way. This way it'll be quicker. Let me bring this over here, and I want to show you this. What you're looking at here is the volatility. This is the last thing I'm going to end up doing, guys. So if there are any questions, put them in, but this is going to be, unless there's any other questions, this will be the last thing I'm going to cover. I know I'm over. This is the implied volatility using the VIX-based calculations of a 30-day options weighted much closer to the money. This is the VIX-based calculation for the options, not on the S&P, but on the VIX options themselves. So in a way, this is the VIX calculation on the VIX. It's the VIX of the VIX, if you will. And they call it the VVIX. Okay, here's what I want you to end up seeing over the last several years. Do you end up remembering? Okay, we talked about the sell-off that we had in 2016. Okay, in January, February. You also take a look at what we ended up having. Right, that's right over here. Okay, let's take a look at I want to take a look at just this piece. You know what? I want to look at this whole piece. Okay, who was trading during the summer of 2015? Okay, if I say a date, okay, August 27th or August, I guess 20, right, week of August 21st, right, 2015. Did any of you just flinch? Okay, because many of you have your scars, okay, the way I had my scars, okay, on that week, okay. The S&P sold off harshly. There was fear what was going to go on throughout Asia. China was having a problem, okay, and the implied volatility just freaking skyrocketed. This index normally stays below 100. It went up to 212. That's an implied volatility of 212 on the options of the VIX. Okay, this was the only real, I'd say, threat that we had that the markets could end up having something just terribly happen, not event risk. Oh, we're worried about an election. This was an economic one, and look at what happened. If I take this thing back and you go to and we've done some other calculations, that's absolutely huge. The high frequency guys are trading the VIX options, the VIX futures, and the VIX-based products more now than ever. By this time, they were fully in this, and if you were in here, you know what happened to volatility, and most of you got your butt kicked. I know people who lost a full year's worth of trading income during this couple of days. Okay. What's happened since then? Yeah, we've had some spikes. Let's take a look at the spikes that we had. This was the spike that we had at the end of 2015. So if I started, say, 2016, this was the lows that we had in January and February, right? The lows that we talk about, that we anchor everything to. This was the lows in the S&P 500. When I say lows in the S&P 500, obviously spikes in volatility. If I just highlight this so that you can see. This was the fear going into Brexit. the vote after the vote happened, we hit a high, and then we started gaining. We came back down. This was the fear that we ended up having around the U.S. elections going into it when Trump started to end up as a Republican candidate, started up going in. There were some fears in and around the market. What was going to end up happening? This was the fears, going into the election. That we thought, oh my God, what's going to happen? If underneath a Trump administration, the market's got to drop 5 to 10%, overnight, and it did drop 5% overnight, but it just happened to bounce back by the close of the same day. And then the fear subsided. What happened here? This was the fear going into the French elections. So this ends up showing you where the real fear is. This is when the institutions, really start to saying, oh crap, we need to protect ourselves. This shows you if fear is real or not. And right now you can see after the primaries of the French elections, we hit a multi-year low. Or close to a multi-year low, exception. And we're starting to climb up a little bit. If you were to take this thing back, and I don't have it, but there's actually a graph, where and we did the same thing, by the way. We did this math before the SIBO actually published it. But if I'll just do a quick search. Let me do a quick search, see if I can find it. No, I don't. I don't have it here. I'll show you where I was looking, guys. It's someplace in here. I was on the SIBO website, products, VIX-based products. VIX on stock indexes, and then what I was looking at this, and I thought that they had a graph here that went back much, 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 much further. And it ended up showing you. It might be in the white paper. Yeah, there was one that went back much further. This goes back to 89. This isn't the one that I wanted to end up showing you, but it does show you an example of if they calculated, what the VVIX would have been. You can see during the last, several years here that we have been moving up higher. And that it has been gaining. And the reason why it's been gaining is that the institutions now are looking to protect tail risk with these options. When do they end up protecting the tail risks? Not all the time, when they really need to, when things start to end up getting fearful. And so that's what ends up happening here. And so this is a way to be able to end up seeing that on the graph that I showed you, the above the money calls and especially the above the money puts really get suppressed over time because there's not the same fear. What they're looking at is much cheaper insurance on the tails. And that's kind of a brief explanation about why that's happened. But it really is the high frequency and the algo, guys. Anyway, guys, hopefully this was helpful. There's a lot of information in here. I think that if you end up watching this a couple of times, you'll end up seeing how I went through, how I drew my lines, and you can do this on your own. For next week, if anybody would like to come on to end up looking at a particular stock or dive in, and we can have a conversation about it, please send me an email. Always looking for people to end up joining in on this, looking to try to make this more of a conversation, more of a trading group type of conversation than just a core dump, a unidirectional conversation that it seems that we normally have. But hopefully this was good for you guys. Take care. Have a good day.